Indian billionaire Gautam Adani's $2.5 billion share sale inched closer to full subscription today as investors pumped in funds following a turbulent week for his group in which his stocks were pummeled by a scathing stock seller report. The secondary share sale of flagship Adani Enterprises was subscribed 93% on Tuesday, including the anchor investor portion, Indian Stock Exchange data showed. And there is more to chew about that right now, including outlook on the U.S. Federal Open Market Committee meeting as we turn to our Rise Business analyst, Bode Ososami in London. Bode, thanks for coming through the Adani story and the whole short seller report, turbulent week. How is this company making it through?
Well, I think over the weekend, we understand Adani held extensive discussions with investment bankers and institutional investors to attract subscriptions. As at yesterday, they were still waiting on the sidelines, perhaps expecting a significant change in pricing or even calling off the sale. We gathered Abu Dhabi conglomerate international holding company said it will invest $400 million in the issue, and others piled in. At close of trading, Adani stocks went up, at least I would say mostly. If you look at the gas operation, it's still down 10%. Adani Transmission is up 3.85% at close. Adani Green, that's green energy business, is up 2.94%. Adani Ports up 2.62%. Adani Power down 4.99%. Adani Enterprises up 2.8%. So not exactly out of the woods. Analysts are still watching developments closely, and especially exposure of Adani to global banks and the size of the exposure, essentially trying to see the impact of some of those bad debts and what could happen in a worse scenario. The 413-page rebuttal answering 65 of the 88 questions asked by Hindenburg Research may have done the trick. But my sense is emerging economies giants can expect to be scrutinized more closely because growth opportunities is going to attract significantly more capital and investment. And in this case, this company was really labeled as very dodgy. We still have many one-man empires out there propped by unclear government alliances, and they can significantly do better with transparency, governance, and to get the full confidence of investors. But my sense is we are in the age of emerging economies, but plenty of work to be done too.
Yeah, plenty of work to be done. This bit of a bittersweet news. Eurozone managed to grow in the fourth quarter, but the UK gets bad news from the International Monetary Fund. How are these two stories developing right now, Bode?
Well, it's good news, bad news. Eurozone just barely not in contraction, quarter on quarter, just 0.1%. Although we did see improving economic prospects in the January PMI flash data, where we saw services PMI rising to 50.7 and the manufacturing PMI also rising to 48.8. And the environment is showing that sentiment is improving, especially in the Eurozone. Household finance is looking better. It was a milder winter. Cost of energy is going down, and of course the disposable income is also looking in a healthier situation. German economic minister last week said they were fairly confident Germany will miss a recession, and that's the powerhouse. So I think IMF seems to agree with that narrative. For UK, it's a completely different story. The UK is facing, they say, the bleakest 2 years of any major industrial nation. According to a survey by Bloomberg, Brexit is costing the UK economy 100 billion pounds a year, and it's not just the exiting from Brexit. UK doesn't have the fiscal ballast that the US, Japan, or the Eurozone have to push a strong economic revival. Exit from the EU has spooked trade and investment, and a pro-EU US has snubbed any US trade deal, preferring to focus on the trade and semiconductors chip war with China. The only choice actually in the UK now is to ease barriers with the EU through a humiliating U-turn, or continue to push its economic revival plans with limited fiscal fuel to finance it, or be forced to pivot to China and emerging markets more aggressively. Of course, you know that's going to be geoeconomically complex, if not impossible. But we'll see how it develops. So many scenarios possible.
Okay, so what's in McDonald's earnings? I haven't tested it in quite some time, but what's in the results, by the way? Tell me.
Had my
What's in the
McDonald's.
middle?
It was a strong quarter. It ended the year. Fairly good note, although how you interpret the earnings per share depends on how you treat some of the exceptional items. I understand consolidated operating income decreased 10%, but 2022 results included 1.3 billion of charges related to the sale of company's business in Russia, and there was an exceptional gain of $271 million related to the company's sale of its dynamic yield business. If you exclude some of these items, you get a different picture. But McDonald's is still seeing increasingly high traffic domestically, which bucks the trend. Why? Customers have cut back fancy restaurant spending in response to inflation, and they've reduced with reduced disposable income. I guess people are finding Big Macs and McNuggets much more tasty. But we'll see what happens. Also, they've done very well in international markets: UK, Germany, France, Brazil, Japan. Of course, China didn't do so well. But those analysts that say McDonald's is still not out of the woods, they believe inflation could increase in more price competition for them and higher costs of automation, as well as some of their customers moving to just eating at home. So if you look at McDonald's shares, again, it's not so good, down 2.06% as we speak.
But are you hawkish or bullish on tomorrow's FOMC? 10 seconds.
Well, my thinking is that it's quite unpredictable. I guess that's my view, because today, yes, we did get another piece of data. Just very quickly, I want to talk about the wage inflation data that came today, which, of course, drives cost of services higher. We saw the compensation cost climbing 1%. Quarterly employment cost index, which is lower than 1.1% expected. But that shows that, yes, wage inflation may be going down, and that may give the doves maybe more enthusiasm. But my sense is the Fed is really nervous about having to fight inflation twice, and it can be easier to do another 50 basis points and be sure they really kill inflation, especially as the economy has been quite resilient. So although markets are priced in 25 basis points, I would easily be 50.
All right, we'll continue from there tomorrow after hearing from Jerome Powell. Thank you so much, Bode Ososami out of London, our business analyst.